Hi, everyone. This is Jason Barrack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's guest is Dave Kranzler. He's a money manager and investor, and he lives, breathes mining stocks and macroeconomic news, and he runs the popular blog website Truth in Gold. So thank you for joining us here today, Dave.
Oh, thanks for having me, Jason. The name of the blog is actually The Golden Truth, and the website address is truthingold.blogspot.com.
Oh, okay. Yeah. Okay. Well, anyways, though, let's talk a little bit about your background, Dave. Now, you worked in finance for a while, and you trained as a conventional finance, and I think I remember hearing on another interview, I think on Kerry Lutz's interview with you, you learned Keynesian economics. So what woke you up about what was really going on in the macroeconomic situation?
Well, actually, just a brief history here. After undergrad, I went to work. I was a two-year analyst at Goldman Sachs, and then I worked at a very small leveraged buyout boutique for a couple of years, and then I went to the University of Chicago to get my MBA, and that was 91. And when I came out, I was a high-yield bond trader for Bankers Trust, and I did that for 9 years. And that kind of, to be successful at it, you needed to combine financial analytics skills with a nose for the markets and an ability and capability to take risk, because you had to run risk positions in order to make markets in junk bonds. After Deutsche Bank acquired Bankers Trust, I moved back to Denver, which is where I'm from, and I was day trading for several years, and I was turned on to the precious metal sector in late 2001. And prior to that, as you said, working on Wall Street, I wasn't necessarily a Keynesian economics proponent, but I was a proponent of anything Alan Greenspan wanted to do to boost the markets, because that's how you make big bonuses on Wall Street is if the Fed's printing money, it inflates financial assets. And it took for me to get away from that whole environment and to sit back and look at what was really going on to understand the difference between fiat currency, unbacked currency, and real currency, which historically for 5,000 years has been gold and silver. So anyway, I started looking at the precious metal sector and the mining stocks, and when you evaluate the value of gold and silver, back then it was a little under $300 an ounce for gold and a little under $5 an ounce for silver, versus today where you're about $17.50 and $32.50 for silver. When you evaluate the price point for gold and silver in terms of dollars, they're extraordinarily undervalued in relationship to the amount of currency base and debt that's been accumulated by our entire system. So to the extent that gold and silver are undervalued, the well-managed mining stocks are extraordinarily undervalued.
Yeah, I completely agree about the mining stocks. And before we talk more about gold and silver, and specifically the mining stocks for listeners out there who want to learn the thought process of a money manager, how to do better research, and a checklist maybe of what to look for in gold and silver stocks, let's talk a little bit more about the macroeconomic situation here. Do you think then the macroeconomic situation as you see it now, are we in some sort of worsening stagflation, or do you see things differently in your own views?
Well, I think stagflation was kind of a term that got popularized during the 70s when we had an economic decline that was accompanied by price inflation. And if you look what was really going on back then is that we had gone off the gold standard in 1971, and immediately the Federal Reserve Chairman, I think it was Arthur Burns, started printing money like crazy. You can go onto the Federal Reserve website and pull up historical charts of the money supply, and you'll see that right after 1971, the money supply started going up at about a 45-degree angle from left to right. and that's really what translated into the price inflation. It gets blamed on the oil embargo and things like that, but it was really a function of the money supply increasing at a rate that was well in excess of the type of wealth that was being put out by the U.S. on a GDP basis. And if you fast forward to where we are now, the money supply and the money printing has increased at an even greater rate, especially since the early 90s. And it's been a tool that the Federal Reserve has used ever since 1971 to kind of inflate the system. And what happens is all that money flows into financial assets, and it precipitated bubbles like the one we had in technology and internet stocks in the mid to late 90s. I'm sure everyone remembers that. And it precipitated the housing bubble. Well, they've kind of run out of things to inflate. They're currently trying to reinflate the housing bubble. They're not having much success at it for a number of reasons. But the whole time, and especially in the last 12 years, I mean, people blame the debt accumulation primarily on Obama, but the previous administration also took the federal debt up by quite a bit. So
two wars. Yeah, you had the wars for Bush. You had Afghanistan and Iraq, and then you had the Medicare Part D. So even George W. Bush was a welfare warfare guy too.
That's exactly right. I mean, the government doesn't really have a choice. It's right now, you know, they have to spend or the economy's going to collapse. And what's become really dangerous about our system is that the level of entitlements and the number of people who are dependent on those entitlements keeps increasing on a monthly basis. In fact, I just did a blog post today that discussed the increase in dependency on food stamps, and when you look at the actual numbers, I mean, it's just mind-boggling. And we're kind of in a situation now where, despite the fact that we're running close to a $2 trillion spending deficit and accumulating close to $2 trillion in Treasury debt on an annualized basis now, if the government were to cut back on that spending, the economic effect would be devastating. And so the government
and politicians and the politicians would also lose all of their jobs. So I don't see that happening either.
Right, and that's what's precipitated the whole problem. You know, it's kind of a chicken and egg thing. Well, I have a quote at the top of my blog post today from Alexis de Tocqueville, whose writings back in the 1800s prognosticated the demise of the U.S. system, and he details specifically why he thinks it'll happen and what will happen. And he's been very accurate. If you go back and you just need to read a summary of his stuff on the internet, and it's pretty amazing. But one of his quotes was, "The American Republic will endure until the day Congress discovers that it can bribe the public with the public's money." Well, that's what we have going on, and that's what the Great Society programs are all about. And there hasn't been a president in there that's done anything to cut those back. And they've ramped up. Some of them have ramped up significantly under the Obama administration. And whether you want to blame that on Obama or not, it was by necessity, because a lot of these people, if you were to cut back on the amount of government spending that's going on things like food stamps, Medicare, Medicaid, Social Security, you'd leave a lot of people out on the streets starving, homeless, and without medical care. So
yeah, I mean, the policy from the central planners for decades now, it's misallocated so much capital and resources, and it sent the wrong signals to the economy in general and to people in general that they can rely on government to depend, and you know, people just they're not very independent anymore.
That's exactly right. I mean, I saw a statistic a couple weeks ago, and you can Google it if you don't believe it, but over 50% of everyone in this country now is now getting some form of direct government entitlement payment. And to me, that's just staggering, because that means that everyone who's working and paying taxes, and we know that the size of the workforce is shrinking every month. Everyone who's working and paying taxes is supporting an increasing number of people who are dependent on the government for economic payments. And it's a situation that I don't know when it's going to hit the wall. I don't know if it's this year, next year, or 5 years from now, but at some point it's going to hit the wall and it's going to get ugly.
So you've laid out essentially then an argument for why then the checks are going to keep coming for the welfare warfare state, and at least the welfare checks are going to be paid in nominal terms to prevent some sort of riot, to create the aggregate demand that the Keynesians want. And the only way to do that then is to devalue everyone's dollars, because I don't see them being able to massively increase the tax revenues any other way. So they're only going to be able to just print more dollars and hand them out then.
Well, that's exactly right, and you hit the nail on the head. Yeah, they can raise taxes, but I read an interesting article. I wish I had bookmarked it just last week, and someone went back and looked at the tax rate going back something like 70 years. And if you measure the percent, the tax revenues in this country as a percent of GDP over the last 70 years, essentially that number has been pretty constant at around 19%. So tax revenues have been, as a percent of GDP, have been 19% of GDP, regardless of what the tax rate's been. And you know, you have to remember that back in the 1970s, the highest marginal tax rate was 90%. And until Reagan got into office, it was 70%, and then Reagan cut it down. But remarkably, the amount of revenues as a percent of GDP has not varied with changes in the tax rate. So yeah, they can.
Well, that makes sense to me, but it doesn't make sense to the PhD economists and the politicians and the bureaucrats. Because I mean, if I have a partner and the partner is not going to do any work, and they're going to take 80% of all my work, and they're not going to take any risk with the capital, or they're not going to do any labor, and they're going to take 80% of the profits. I mean, what's the point of expanding your business then?
That's right. And the fact of the matter is, if they can go ahead and raise the tax rates on corporations and wealthy individuals, but that doesn't mean they're going to be successful in raising any more revenues from those guys, because they'll either shut down sources of revenue to avoid paying taxes, or they'll take it offshore, or they'll find ways to hide it. You know, and Obama's talking about closing loopholes as a way of raising revenues from the wealthy, and I don't think I can ever remember any tax loopholes being closed. If anything, if they cosmetically close some loopholes, they write stuff into the legislation that opens up new loopholes. So
it's just going to be more work for the tax lawyers and the tax accountants. That's it.
Right. That's exactly right. I mean, the tax rate argument is ridiculous. I mean, look at the tax rates in Europe, and Europe has the same problems we do. Our problems are
they have a massive underground economy.
Pardon me?
Oh, yeah, Europe, especially Spain, I think, has a massive underground economy. I think Spain's underground economy is close to 40% of all their GDP, it's estimated.
Well, without even getting into the underground economy stuff, if you look at the tax rates over there, they're much higher than over here on individuals, and they still have the same deficit spending problems that we do. Ours is just a lot more significant. So, I mean, really the bottom line is the government is spending way too much money in excess of what the level of wealth is that's being produced by the country. And unless they cut back on spending, the situation is just going to keep getting worse until it hits a wall. And the problem is, if they do cut back on spending in a way that's meaningful and significant, they're going to throw the economy into a massive depression, and you're going to have riots in the streets because people are going to go without entitlements.
Yeah, and I think that's part of the problem here. And like I said, it's also going to prevent the politicians from doing that, because then they're going to get thrown out of office too. So I think they would rather print and hand out checks that are less worth in nominal terms than risk losing their position, because a lot of these politicians don't have any private sector experience. They can't do anything but be politicians or lawyers, really. So I think you've laid out a really good...
I was going to say, throughout history, that's always been the solution, is to print until you collapse. And probably the last and best example in a major economic power, there's been plenty of examples in South America and other countries, Zimbabwe recently, but the Weimar regime in Germany, which saw the mark collapse in 1923. I think that's kind of where we're headed at some point.
Yeah, I mean, I don't know exactly when we could have a potential hyperinflation, but right now the Fed has looked out that velocity of money has been very, very low, so they've been able to print all this monetary inflation, and the inflationary expectations and velocity of money here in the U.S. are extremely low for the most part, except for people like you and me and some other people that have woken up. But you still have a lot of mainstream people, the people on Wall Street, and the people who have been trained in Keynesian economics, who are worried about the evil deflation boogeyman.
I got to think it's just political jawboning to support more printing, and we are going to see more printing. I think we'll probably see an expansion of the QE3 program at the December Fed meeting, the FOMC meeting, and it's already been pretty well telegraphed that they're going to take it up from $40 billion a month to $85 billion a month. They have to, in order to finance Treasury debt issuance, because we're going to hit the debt limit any time now, and they're going to have to raise the debt ceiling. And so they're going to have to print up new money in order to pay for the new debt issuance.
Yeah, very good point. So that leads us back then to gold and silver. Gold and silver have gone through a lot of painful correction, really the last 12 months or so. They've been up a little bit recently. The mining stocks, for the most part, has been a rough 18 months or so for many of the mining stocks, unless there's a few exceptions to that rule, like a Sandstorm Gold or some of these others, where the company has a really good business model. It's not a normal mining company. They haven't had the input cost increases. So what's your opinion of the gold and silver mining industry going forward?
Well, I think it's an interesting question because, I think that just in general, from a conceptual basis, that the sector is extraordinarily underinvested in, not just by the general public, but by large institutional investors. If you just take a cross-cut of big institutions, pension funds, insurance companies, mutual funds, general money managers, less than 1% of the asset base in this country is invested in the precious metals sector. And to contrast that, by the end of the run-up in the last gold bull market, which ended in 1980, over 6% of the asset base in this country was invested in the sector. So,
and that was with Paul Volcker defending the dollar too.
That's exactly right. So what you're looking at here is, at some point, institutions are going to start waking up to this sector, and they're going to start moving some more capital into it, and it's going to push the valuations higher. And it won't, because the sector on a relative basis is so small, it won't take a lot of capital to push up the relative value of mining stocks and of course, the relative value of gold and silver.
Okay,
so that's
good.
One trend that I see coming. And the second part of your question is that the mining stocks are extraordinarily overvalued in relationship to where gold and silver are priced now. In fact, if you look at them relative to the price of gold and silver, just take a snapshot today. If you look at that valuation ratio, they're actually cheaper than they were back in 2002, 2003, when we probably had our first big run-up in the sector once the bull market started. So on a relative value basis, over the last 11-plus years, the mining stocks are extraordinarily cheap.
Yeah, I would agree with that. I mean, I do valuation analysis for ourselves and our consulting clients at Wall Street from Main Street. And for some of these gold mining companies, the proven and probable gold reserves, you can buy gold in the ground. Like I said, proven and probable. It's not a measured and indicated ounce. It's not an inferred ounce. You could buy it for under $200 an ounce for some of these companies. For silver, you're looking at $1 an ounce for some of these companies. It's pretty ridiculous. I think, though, the problem with the industry, and this is why Wall Street won't put more money into it right now, like the large money managers, like you said, is the industry has done a very, very poor job over the last decade getting a good return on invested capital. They've not used their capital very inefficiently. There's been very high capex problems with the mines. They've not a lot of the management teams have not done what they said.
That's right, and the large, I tend to stay away for the most part from the very large cap mining companies. I think most of them are poorly run. Most of them have hedges on their balance sheet, hedging out future production. Barrick supposedly removed all of its hedges in 2009, but if you read through the fine print in the footnotes of Barrick's 10K, you'll find that they have some property-specific hedges that they don't call hedges. I think they call them production hedges or whatever. They got some gimmicky name for them, but in a sense, they're basically hedges. And so Barrick is a good example of one that hasn't really come close to participating in the increase in gold from $300 an ounce to $1,700 an ounce. I mean, the price of the stock has gone up, and they have done some good things, but it's a slow-moving, not well-managed company, and most of the large mining companies are depleting their resource base through mining and production much more quickly than they are replacing their resource base. So
yeah,
for those reasons,
and Barrick has also. Sorry to interrupt you. And Barrick has also, I think they spent, $6 billion raising the equity financing to get rid of those hedges, and you said they didn't even get rid of all of them.
They didn't get rid of all of them. I mean, they took a big swat out of them, and it was helpful, but it's just never been a really well-run company. I mean, most of the large caps seem to be like that.
Okay, so what then as a money manager, since you do actually manage a portfolio that holds physical gold bullion and also gold mining stocks, what types of things do you look for then out of a company and out of management? What types of things for listeners then should they look for as like a checklist then for a good company to start doing research on? Sure.
Well, the way our fund right now is allocated, we're about 60% of the capital is invested in physical gold and silver bullion that we safekeep at a private depository in Delaware. And then about 40% is invested in mining stocks. And of that, it's roughly 50-50 spread out between kind of intermediate stage producing companies. We have one or two large caps in there, and then the junior mining stocks. So the way that I define a junior mining stock versus a producer mining stock or an intermediate to large cap mining stock is that a junior mining stock needs to raise capital every so often in order to fund its exploration activities. It can't sustain itself out of cash flow, mostly because it's probably not producing any cash flow. And then contrast that with the intermediate term and the larger cap stocks. They don't necessarily need to go to the capital markets to fund their operations. They're self-sustaining from cash flow and from production. With the junior mining stocks, my checklist consists of, number one, I'm sensitive to political jurisdictions, and so ideally, I'm only putting money into juniors that are operating or exploring in North and some parts of South America. Now, if a situation warrants it, I'll go outside of that. And the West African region is another area that for now anyway seems to be politically pretty safe. and then, there's other areas sprinkled about. Turkey's another one that it's not quite as safe as West Africa or North America, but if the opportunity is right in Turkey, we'll take a look at it. And we are invested in a junior that has some projects in Turkey, but it's got a well-diversified portfolio of projects. The second thing is, now within the junior category, you've got basically runs the span from companies that have some property they're going to start poking holes on, and that would be your pure exploration company, versus some that have proven resource material on there, NI 43-101 reports that they put out. And so we don't invest in anything that's just a pure evergreen exploration situation. They have to at least have drilling results with credible assay results, and with those situations, they need to be poking holes in and around areas where there's existing mining activity that's going on. So the ideal situation is a company that already has measured and indicated resources, but those are hard to find that I would categorize as being undervalued. The third thing I like to see is, ideally I want to see management have at least 10% of the equity. And when you throw that in there, those situations can get hard to find. But we do have some in our portfolio. But if I'm going to put my money into what's essentially a venture capital operation, I want to be betting on management that has their own money in the game. And fourth, we want to see companies that have an investment from a large cap mining company, and the ones that we invest in general have about large cap mining companies that own about 10% of the equity. So a company that fits all of those, a perfect example of that is one called Rye Patch Gold. And they fit all of that criterion, and to me it's an extraordinarily undervalued situation. And we have a bunch of other investments in the fund that somewhat fit that checklist, but again, that's sort of the ideal checklist for juniors.
Very good. And we at Wall Street for Main Street use a similar checklist. And, for the producers, a lot of these producers, they have a diversified asset base. They have mines in Mexico or Canada or a couple other countries. So if a government gets too greedy, if the government changes the rules like in Argentina or Peru, because Peru used to be mining friendly until pretty recently, and now Peru started to even change the rules there. So things can change pretty quickly, especially with some of these South American governments like you mentioned, because most of their economy is just developed on only the resource sector and revenues from mining or oil and gas. So that makes things dangerous to be overinvested just in one of those juniors with only one deposit in those countries.
That's right. I would agree with that. And again, South America is a country by country situation, and Argentina is a province by province situation. So it really requires, if you're going to look at these companies, you got to look at the fine print on where they're operating or where they're exploring and what the governments look like.
Exactly. I completely agree. As we wrap up the interview, Dave, what expectations do you have then for gold and silver over the next, 18 to 24 months? Do you think most of the pain is already priced in then in terms of downward side, or do you think there's going to be a sovereign debt default or a Lehman type event that the political and economics elites are actually going to allow, like in terms of free market forces? Or do you think that's just going to all be papered over some way, one way or another, and then gold and silver prices, I guess, are going to be managed higher?
I think your latter scenario there is the one that I think is the more likely one to happen. I mean, if the government stopped printing money and enforced traditional accounting standards on the banks, all of the too big to fail banks would probably blow up. And people might find that hard to believe that I would say something like that, but if you apply the accounting standards from 20 years ago and you make these companies mark to market their balance sheet, they're all insolvent. And the number one reason why the Fed has been printing money is to keep the banks solvent. Part of the reason why, as you pointed out, the velocity of money is so low and why we haven't seen serious hyperinflation from all the money the Fed's been printing is that a good part of that money is being held in the excess reserve account at the Fed, and that's what that is it's money over and above what the banks need in their day-to-day operations, so they don't need to that money is not running through the outside system, meaning the system that exists outside of the Federal Reserve banking system.
Yeah, it's not in the real economy yet. There's no lending spending of the money. It's just going into, like you said, it's being docked at the Fed. It's being used to buy treasuries so the U.S. doesn't have an official default, and then it's going into commodity markets and other asset markets to be speculated with, or it's going into the over-the-counter market on the derivatives for the banks to cover losses there.
That's right. But if the Fed basically turned off its printing press and closed its discount window, that money would have to come back into the system pretty quickly, or the banks would collapse. So I think what we're going to see here is things that otherwise might be collapsing get papered over, and so you don't necessarily hear about it. I mean, perfect example is what's going on over in Greece. I mean, they're sitting there waiting for $31 billion in new aid to get approved from the ECB system, and in the meantime, they've got a $5 billion Treasury bill expiration that if they can't go out and float new Treasury bills, they're going to default on those Treasury bills. Well, the reason why they haven't been able to issue new Treasury bills up until today was that they've run out of collateral that the ECB will accept in lieu of cash for them to float the Treasury bills. So high quality collateral, that is. Now, I just read that the ECB has taken down their collateral standards for Greece so that Greece can go ahead and do the Treasury auction, and they'll kick the can down the road again until the $31 billion eventually flows in there, which it will. And it's just like the situation in our country. You've got this fiscal cliff. Well, they're not going to let the fiscal cliff happen. Somehow, some way, they're going to reach some sort of agreement that kicks the can down the road, and that will also include raising the Treasury debt limit. They have to, otherwise the country shuts down. So with that as the backdrop, I think gold and silver are incredibly undervalued right now. I don't think it's pricing in a lot of the printing that we're going to see over the next 12 months, the printing that has to happen in order to keep the Western Hemisphere operating.
Yeah, I completely agree, and I think we could debate about where a price floor is for gold, silver, and perhaps oil, but I think there's definitely a price floor underneath them because of the Bernanke, well, I don't know how long Bernanke is going to stay there for now, but as long as the Fed's going to allow Congress and the President and the government agencies to continue spending massive amounts of money, and they're not going to force them to cut back, the Fed's going to put then a floor, like I said, underneath gold, silver, and oil at certain price levels.
That's right. Although the way I would look at it is that India and China have now put in the price floor on gold and silver. I mean, every time they try to take it gold below 1,700, it bounces back very quickly because India and China go in there and buy like crazy. China's been importing a record amount of gold just about every month for the last 18 months. I think where the Bernanke situation is he basically raises the ceiling on the price of gold and silver every time he increases QE. So in terms of the next 12 to 18 months, I think $2,500 is probably a realistic price target for gold, and probably $75 for silver.
Yeah, I think with the silver chart, like silver has a lot of overhead resistance left between these levels and 50, but once it gets through that old Hunt Brothers high of 50, I mean, it has no overhead resistance left on the chart. It's literally in uncharted territory. So, like the angle on the chart, it can go up much higher, much faster than people expect. So I think that's pretty reasonable there. And then, you know, you add in the fact that you have all these Wall Street and trend trader guys who are not attached to any position fundamentally like you and me might be, and these guys are out of the market for the most part right now. But as that silver chart starts to pick up technical strength, then they're just going to come back in and they're going to push that trend a lot higher than people will rationally expect it to.
Yep, that's I totally agree with that analysis.
Okay, well, Dave, in wrapping things up here, I just want to thank you again for your time, and please tell our listeners more about your blog website, which you spoke about earlier in the interview, and then also tell our listeners about your hedge fund that manages money if they're interested in maybe contacting you about more information about that.
Sure. Well, my blog website, as I said at the beginning, is www.truthingold.blogspot.com. And I basically kind of write about whatever is in the news that annoys me when I wake up. I try to focus on geopolitical issues. And
there's a lot of things to be annoyed about.
You got that right. And I try to work in how the precious metals fit in with that. I also kind of, one of my pet peeves is the housing industry, and I think the housing market is still got a lot more downside on it. And at some point in the next couple of weeks, I'm going to post a big report on, or a big blog post on the housing market and why I think it's going to go a lot lower. And occasionally I'll take apart bank earnings and explain where they're stepping outside the boundaries with their accounting and point out where they've inflated their earnings for that particular quarter. So that's kind of the focus of my blog. It's somewhat irreverent, so it's not for children, because sometimes I throw some four-letter words in there just for effect. In terms of our fund, the name of our firm is called Golden Returns Capital, and the name of the fund is Precious Metals Opportunity Fund. And one of the things that makes us unique is that when an investor cashes out, he has the option of receiving his pro rata share of the gold and silver bullion that's in there as part of his investment cash out. So if someone were to cash out today and our fund is 60% physical bullion, we'd offer him the option of receiving his share of the gold and silver that's in the fund. We mainly invest in 1-ounce sovereign minted bullion coins. That would be like gold eagles, maple leafs, philharmonics, that type of thing. And that's so that we have the liquidity in terms of the bullion to deliver to people when they cash out. We also do take, on occasion, delivery of bullion bars from the COMEX. So we do have some bars in the fund. And then the premise of the fund is as we discussed earlier, the base case model is 50% bullion, 50% stocks. So right now, for about the last 2 years, we've been overweighted in the bullion, which has been a good decision because the bullion has outperformed the stocks. And I think over the next 18 to 24 months, I think the stocks are going to start outperforming the bullion because they definitely have some catching up to do. And the fund is actively managed. I trade the mining stocks and do all the research, and one of my other partners trades the gold and silver futures side of our fund. That's a very small portion of our fund. We use it primarily for hedging the bullion. You know, when there's periods of time when we think that we may get a market correction, we'll throw hedges on there, and we also use that in case we decide we want to take some delivery of gold or silver bars off the COMEX. So if anyone wants to get in touch with me about our fund, my email address is linked on my blog, but it's Midas 10K the number, at Comcast.net, and they can go ahead and get in touch with me through there. We have a website, but for regulatory purposes, it's not accessible to the public. But if they get in contact with me, I can set them up with a temporary password to get all the information about our firm and our fund.
Great. Just want to thank you again, Dave, for coming on a Wall Street for Main Street podcast, and hopefully we can have you back on again soon to talk about the gold market and the macroeconomic situation.
That sounds great, Jason. Thanks for having me, and I'd love to be a guest again.